In a surprising turn of events, several law schools in the United States have decided to boycott the U.S. News & AMP World Report rankings this year. This unexpected revolt has been fueled by a growing dissatisfaction with the ranking system and its perceived shortcomings. At the heart of the matter are concerns around the pressure to admit students with high grades and test scores, sidelining other significant factors such as potential for growth and commitment to public service. Critics argue that the rankings tend to disregard students pursuing certain public interest or academic jobs, thereby creating an unbalanced representation of a law school's worth and contribution. The University of Pennsylvania Carey Law School, University of California, Davis School of Law, and University of Washington School of Law have all taken a stand stating they will not provide their internal data for the rankings. On the other side of the divide, Washington University in St. Louis, School of Law and University of Georgia School of Law have decided to continue participating in the rankings. This divergence in approach has sparked a broader conversation about the role and relevance of rankings in the educational landscape. Bob Morse, head of U.S. News Rankings, has been actively involved in these discussions, engaging with law school deans to address their concerns and possibly reevaluate the ranking methodology. How this revolt will impact the future of law school rankings remains to be seen. Will more schools join the boycott? Will the rankings methodology undergo a substantial overhaul? Or will things return to business as usual? For now, the exodus from the rankings continues to stir up conversations around the integrity and relevance of such systems in education. Canadian banks face backlash as they double their funding for highly polluting oil projects, contradicting their commitment to reach net zero emissions by 2050. This surge in funding specifically targets tar sands oil projects, notorious for their high carbon emissions. Tar sands are incredibly carbon-intensive, emitting more greenhouse gases than conventional oil. Since the Paris Climate Agreement, Canadian banks have emerged as some of the largest global investors in these tar sands. Among those involved are TD Bank, RBC, CIBC, Scotiabank, and BMO. Together, these banks funneled a staggering $88.8 billion towards tar sands producers and pipeline companies between 2016 and 2021. This investment trend does not align with the bank's stated commitments to prioritize climate change. In fact, last year alone, these banks invested $742 billion in coal, oil, and gas companies. Despite calls from shareholders for stricter climate policies, RBC, CIBC, and Scotiabank turned a blind eye. Such a significant discrepancy between words and actions could have serious repercussions. With growing public support for phasing out fossil fuels, these banks risk alienating clients. Charges of hypocrisy could also undermine their credibility. In order to meet their net zero targets and maintain public trust, these banks will need to make significant changes. Short-term financing gains should not overshadow the long-term benefits of sustainable practices. The actions of these banks raise questions about the sincerity of corporate commitments to sustainability. The SALT Conference in New York has been the center of attention this week, with top financial leaders discussing money, markets, and a significant emphasis on crypto-related topics. In the heart of the Big Apple, a whirlwind of financial discussions has been taking place. The SALT Conference, a congregation of the brightest financial minds, has seen a buffet of ideas and opinions, with cryptocurrencies taking center stage. FTX founder Sam Bankman-Fried, a leading figure in the digital asset space, expressed a buoyant optimism about cryptocurrencies, challenging the downbeat mood in digital token markets. Further, the conference served as a stage for significant business moves. Skybridge Capital's founder, Anthony Scaramucci, unveiled a deal with Bankman-Fried, with FTX Ventures set to acquire a 30% stake in Skybridge Capital. It's a move that echoes the growing intersection of traditional finance and digital assets, underscoring the conference's focus on cryptocurrencies. But it wasn't all smooth sailing. Bridgewater's co-chief investor Greg Jensen issued a stark warning, suggesting that asset prices could tumble by as much as 25%. A sobering reminder of the unpredictable nature of financial markets. Meanwhile, the conference wasn't without its logistical hiccups. Reporters faced challenges finding adequate workstations, a testament to the conference's draw and the unyielding hunger for information in today's fast-paced financial world. On the broader market front, U.S. stock futures have been clawing back some losses, following a sharp fall triggered by unsettling inflation data. Oil prices too have been on the mend, with the International Energy Agency predicting a halt in global oil demand growth, offering a glimmer of stability in an otherwise turbulent market landscape. The SALT Conference continues to shape conversations in the financial world, especially in the realm of digital assets. This week's discussions have underscored the growing importance of cryptocurrencies in global finance, and it's clear that this is a conversation that's only just beginning. In other news, here are some rapid-fire updates from around the globe. Over in the United States, the Biden administration is weighing its options, considering a refill of the Strategic Petroleum Reserve. This move is geared towards safeguarding the nation's oil production growth and ensuring a steady supply of this essential resource amidst fluctuating global market trends. Meanwhile, across the Atlantic, Germany is formulating a fresh strategy for trade, with a key focus on reducing its reliance on China. This development is seen as a significant shift in the global economic landscape, as nations strive to diversify their trade partnerships and maintain a balanced economic ecosystem. And on Wall Street, investors have had a bit of a roller coaster ride. The Dow, a major stock market index, recently plummeted in its worst session since June 2020, dropping a whopping 1,276 points. This dramatic fall has sent ripples through the financial world, stirring discussions about market stability and future investment strategies. In addition, the upcoming Federal Reserve meeting is causing a stir among investors. They're pricing in the odds of a significant 100 basis point rate hike, a move that could have far-reaching implications for the economy. Finally, a word from BlackRock's iShares. The head of investment strategy believes there's a growing disconnect in the market as activity cools and prices rise, a trend that investors will need to navigate with caution. As always, news from around the world continues to keep us on our toes.